Okay, so what we're looking at today is an analysis of Resolve AI, ticker RZLV. The report makes a really forceful case that the recent, 8.33% drop is a major buying opportunity.
A huge one.
It's all based on strong technical support at 220 and this big projection of $200 million in annualized recurring revenue by the end of 2025.
Right, a very compelling long-term story. The core conviction is fantastic. Let's get into it.
I agree. So right out of the gate, the analysis takes a very strong stance. It dismisses the drop by saying, and I'm quoting here, this drop is just short-term traders taking profit.
And that's a clean, confident opening, for sure. But it's also, I think, the first real point of vulnerability.
How so?
The analysis would be significantly more robust and, frankly, more credible by actively seeking out and neutralizing the specific reason that drove that decline rather than just dismissing it as noise.
I see that. So while a contrarian has to ignore the panic, a really sound analysis has to first show it's done its homework.
Exactly. By just saying it's profit-taking, the report kind of risks appearing, well, a little incomplete, maybe even slightly lazy.
It signals to a smart reader that maybe you only looked for things that confirmed your own bullish view.
Yes, an 8% single-day drop, that's not always just noise. Sometimes it's a real signal, even if it's temporary.
And you're just avoiding the elephant in the room.
And an investor is immediately going to ask, right? Was there a bad filing? Did a competitor get a big win? Was it just a sector rotation? Precisely. If the analysis leaves any doubt about the actual cause, and you don't address it, the whole bullish argument, no matter how good that 2025 guidance is, it just becomes brittle.
You have to defeat the bear case.
You have to defeat the bear case, not just act like it's not there. Your analysis only gets truly compelling once you prove the long-term story outweighs whatever pushed the stock down today.
So the goal isn't to write a whole negative section, but just to show that the bullish conclusion came after checking out the source of the drop.
That's it. So the suggestion is that the material needs to integrate a short, balanced segment that explicitly names and addresses potential reasons for the volatility.
And that makes your conviction look earned.
It does. It shows you did the work. The strength of the analysis then comes from proving the long-term fundamentals are just so dominant they neutralize that short-term hit.
Okay, that's really actionable. So how do you do that quickly, without derailing the whole positive tone of the report?
You keep it really concise. Frame it as a known risk that's already been contained. So for instance, if the drop happened on a bad market day, you could just briefly state something like,
Give me an example?
some market participants may have reacted to specific event X, like the new CPI data. We acknowledge these external factors, but they're temporary headwinds. Our focus remains on the proprietary, company-specific guidance, which is the real driver here, and is completely unaffected by this noise.
I like that. That small change immediately makes the whole thing feel more researched. It tells the reader, I looked at the bad news, and I'm still telling you to buy.
Precisely. It turns a potential weakness, that unexplained drop, into a demonstrated strength, your due diligence.
Fantastic. Okay, let's move on to the second point, which is all about framing that massive upside.
Yes, this is critical, especially if you're trying to convince a skeptical reader.
So the report does a great job of creating excitement. It says Wall Street analysts have price targets as high as $9 or $10, and that's what drives the 300 to 400% upside calculation from the current price.
It's punchy, and that 400% number is a great headline. But, and this is important, that enthusiasm needs to be grounded just a little bit for maximum persuasion.
So the topic sentence here would be what?
To optimize the presentation of the risk-to-reward calculation, the report really needs to provide necessary context for those highly aggressive $9 and $10 price targets.
Okay, so the weakness is just throwing out the highest possible number without the surrounding data. Like, what's the consensus? What's the full range of estimates?
Right. When you only present the absolute best-case scenario, it maximizes the emotional punch, but it can erode trust. The reader is left wondering, is that $10 target from 5 big banks, or is it from one outlier firm?
And if it's just one outlier, the whole argument feels like it's built on a shaky foundation.
Exactly. You don't want your entire thesis resting on the most optimistic scenario imaginable.
But the writer is clearly trying to be aggressive. If you start focusing on the average target, let's say it's $6, do you risk losing that 400% excitement? How do you ground it without killing the hook?
That's the key balance. The suggestion here is to anchor the discussion with a wider view. You keep the $10 target, absolutely keep it, but you frame it as the potential ceiling.
The best case scenario.
The potential ceiling under ideal conditions. Then you bring in the consensus target as the more probable, grounded expectation. It actually makes the forecast feel more measured and, counterintuitively, makes that 400% gain feel more believable because the analysis feels more honest.
So the $10 target is the headline, the hook. But the $6 consensus is the foundation of the thesis. It manages the reader's risk perception.
Perfectly put. If you only talk about $10 and the stock stalls at $6, your reader might feel misled. But if you anchor them to the $6 consensus, which is still a massive return from $2.25, then the $10 becomes the bonus, the ultimate prize, not the base expectation.
That's a really subtle but powerful shift. Can you give us a concrete example of how that would sound in the report?
Sure. It could be something as simple as, while the most bullish target reaches $10, representing the maximum reward, the broader Wall Street consensus sits near $6. Crucially, even this average target suggests a 170% return, proving the thesis is sound while keeping the $10 target on the table if that 200 million ARR target is decisively exceeded.
That's great. The consensus target proves the value, and the max target provides the excitement.
Right. It shows the investment case works, even if you don't hit a home run.
Excellent. Okay, let's hit the third critique. This one is about the tension between the immediate call to action and the long-term support for it. The pacing feels a little off.
I agree completely. It's what you might call pacing whiplash, a kind of temporal dissonance.
The report uses this really high-energy immediate language. Boom, in after-hours trading, the stock immediately bounced. It says the reversal is imminent. The tone is very much buy now. But the main justification is the 200 million ARR projection for the end of 2025. That's almost 2 years away.
And that jump is the definition of a logical gap. So the analysis should actively bridge the temporal dissonance between the highly urgent, high-energy tone and the long-term nature of that primary supporting data.
The weakness is pretty clear. You're rushing the reader from a tiny technical signal, a 3% after-hours bounce, straight to a 2-year outlook. The urgency to act now isn't really connected to that long-term guidance.
Exactly. An imminent reversal needs an imminent catalyst. If the main support is 2 years out, why do I have to buy today? That little bounce isn't enough to justify the aggressive tone.
So you need a trigger, something happening soon.
You need a near-term trigger, a forcing mechanism that makes the 2025 ARR target relevant in the next few weeks or months. Without it, the advice is just buy because 2025 looks good, which, lacks the urgency the report is aiming for.
So the suggestion is to introduce a specific short-term catalyst that will force the market to reevaluate that 2025 guidance much sooner.
That is the crucial connective tissue it needs. You have to tie the immediate technical setup, the bounce-off support, to the long-term story. That's what justifies the high-energy tone. It makes the window to buy feel genuinely urgent.
That makes perfect sense. The dip only matters if there's a known event just around the corner that could be an inflection point. What are some examples of a catalyst like that?
You'd want to find something on the calendar, something happening in the next few months. So, for example, after you mention the 200 million ARR target, you add a sentence like this. This dip is critical right now because the next catalyst is pending, whether it's the Q4 earnings report in 6 weeks or the upcoming Analyst Day next month. That event will be the moment institutional investors are forced to start pricing in the 2025 forecast.
Ah, I like that framing. It shifts the focus from passively waiting for 2025 to actively getting ready for a known imminent event.
Yes, and then you finish the thought. You say something like, this isn't about waiting until 2025. It's about the market's imminent re-rating of RZLV based on that guidance. And the current price is your last chance to get in before that forward-looking pricing kicks in.
And that fully justifies the reversal is imminent claim, because now there's a hard catalyst on the horizon. The analysis goes from strong conviction to ironclad logic.
It ensures the piece has great data, great conviction, and a structurally sound argument.